Good evening, everyone. Time for another silver update. This is the 1 hour euro chart provided by Netdania.com. You can click on the link below. This chart is actually somewhat similar to the silver chart, which is kind of strange. We've got a sort of bottom forming here in the euro, and as you know, the news out of Europe has just been horrendous, and it's fast and furious every day. You can see it on my blog. Roughly half the stories that I post are about Europe and the euro, and Greece, etc. So it's a developing story, but the contrarian in me tells me that probably it's going to go the other way. I think that will probably rally, but I just don't know. So let's jump over to the silver chart, which looks very similar to the euro, which of course is a mirror image of the dollar, so I guess that's not that surprising, although really I don't really see why paper should be connected to physical. But then again, this is a paper silver market compared to a paper currency market, so that does make some sense. So let's draw the trend lines, because we're kind of at a juncture point. We've got one primary trend line starting here, which you can see touches 1, 2, 3 times. You've got one there, a test there, and then up and through, and we're down below. So we want to draw this rally line, or where we're at there. And we also want to draw the primary trend line from up here to show how we're in a breakout from that, where it crosses right there. So we're kind of in this V formation here, trying to look for where they're going to round off to the downside, or we're going to break out up to the upside. Now, we've had a very distinct pattern that has been going on for a number of days, and of course, really, if you look out over the long term, it's been going on over a number of years, and that is, we're rallying in the Asian time frame, and we're sinking at the New York Open. That actually makes sense if you think about it. Now, I've speculated as to what China's role is in the silver suppression scheme. If you remember the Spark video that I covered yesterday, or the other day, in my last video, I excluded China, saying that they probably are part of this suppression. I don't really know. I've posted a lot of blog articles on China's accumulation of gold. A lot of people are covering that, and China has kind of a strange pattern with gold. They will increase their accumulation and say they're doing one thing, and then when it comes out years later, they've actually been purchasing a lot more than they said they were at the time. So they have this way. A lot of commentators have referred to the fact that the Chinese are very long-term oriented thinking. While we may think in the quarter or the next quarter, they're thinking in the decade or the next decade, or perhaps even in terms of the century. So they're looking at a very long-term picture, and it seems that they're slowly accumulating precious metals. But as you know, China used to be an exporter of silver. They're now an importer of roughly 100 million ounces a year, and that's a significant change. But just to look at this issue real quick here, we want to throw up the volume information, and then we probably want to back down to about, say, the 10 minutes. So we're looking for the smackdowns. You're going to look for this 11 o'clock figure, which is going to show up on most of your charts. You've got 11 o'clock and then 7 o'clock. So roughly about halfway between there is going to be the New York Open. So you can see we've got the smack right there. Let's go back to the other opening. Same thing, same thing, same thing. So I wanted to use that to segue into an article that was covered on Zero Hedge, and bear with me here because I've got a lot of stuff to cover. The article on Zero Hedge, I don't know if you caught this, but it's very interesting. Tyler had put this out a while ago. Actually, back in August of 2010, he started talking about this fund. I don't know if this fund exists or not. It was just an idea. Basically, it's an overnight long. intraday short gold fund. The idea was to go long in the night when Asia trades and to go short in the day when New York trades. Now you can look, these are the charts that were yielded of this trade, and it's pretty incredible that, I don't know why these guys keep opening a new page, but anyway, I can't get to the closest view, but you can see the difference. The blue line is the short intraday and long overnight index, and the other one, the red line, is the long gold buy and hold. So you can see that a long gold buy and hold has seriously underperformed the long overnight short day trade. So it's definitely clear that there is overnight shorting going on. I'm sorry, overnight buying going on in Asia and daily shorting going on in New York. Now, it makes sense because we suspect that it is the Western banks that are behind the suppression of gold and silver prices. And that makes sense because it is the Western banks that are printing fiat currency and foisting it off on the rest of the world to support their endless wars and socialist welfare states. So that makes perfect sense that that's happening, but that makes the chart much more interesting because we've had some really strong moves in the overnight the last few nights, and we've also had some interesting volume, higher volume than we've seen in the past, which was just very like Globex type trades. You can see here this churning here. That's a Globex type churning. So it's a very interesting story that it seems to be a battle between the East and the West in the overnight and the day, and we'll see how that resolves. Of course, you know what my guess is. That's going to resolve to the upside, and it's going to resolve violently to the upside eventually. So I wanted to take you over to the blog to go to a story that I'm going to try to find this story. It's a brief YouTube snippet from David Morgan, and he is pointing out something really important about investment in silver, and I'm going to get into that when I begin to look at the percentage of precious metals as an investment. So let's take a second here and listen real quick to the point that David makes.
Another myth that we have in the silver market, and this one you hear primarily from coin dealers, bullion dealers, especially those that are, maybe been chided in the last bull market when silver ran so quickly. Basically in 1 year's time from $6 to $50, a big move in a short amount of time. You'll hear, well, I think everyone should own a little. And what they're implying is that, everyone should have a little gold and silver. And they're really not that in tune with the global system or what's really going on. They may have been actually more so in the previous bull market. Regardless, it's one of mine that I love to dwell on. Everyone should have a little. Two very ambiguous terms. What is everyone and how much is a little? So in the context of everyone, we could think of every human being on the planet. That would be over 6 billion people. But I'm going to narrow it down. We're going to use about 5% of the world's population, and we'll just say everyone in the United States. And that's round numbers, 350 million people. And now we need to define a little. How much is a little? Well, I'm not going to use 1 ounce as a little because 1 ounce at the time we're doing this is about $30. And I don't think anyone would say $30 would significantly change their life. Maybe $30 in lottery tickets and hit the lottery, certainly that could change your life. But $30 in any investment that I can think of, probably, even the most far outdated option that comes true, probably wouldn't significantly change your life. So I'm going to go to 2 ounces, which certainly $60 wouldn't change your life. So I think I'm well within the realm of a little. The reason I chose those two numbers is simply this. There's roughly 700 million ounces of silver mined every year. A little bit more, a little bit less, depending on which study you use and what numbers you gather. But round numbers, you can up it to 800 million. But quick math, 350 million people times 2 ounces, 700 million ounces. So that roughly covers the entire global silver supply on an annual basis. And yet, this is a small, small number relative to silver's total position. So there you have it. If everyone in the United States bought a little silver, you would be buying the annual mining supply of silver without even thinking about it. However, if you applied it to everyone worldwide buying a little bit of silver, I think you can see my point. The point is very simple. There are a lot more people than there is silver available for investment, and I've maintained that all the way up. What's funny is that the amount of silver that is above ground, that is held already, is in tight hands. So the float, or the amount of silver that's actually up for auction on a daily basis, is not that great. Much smaller than the 700 or so million ounces is mined. Most of that's already accounted for in the future, not so much in the futures market, although you can make that case. The point I'm making is that most of the silver users already have hard contracts in place for silver out in the future that they absolutely need to have supply to them to continue their businesses, be it auto, be it solar, be it chemical. A lot of that silver has already been bought ahead of time. As it comes out of the smelter, it's already got a destination. Back to the saying, everyone should own a little. Not everyone can, and not everyone will. There's a lot less silver out there for investment than most people think.
So that's an excellent point that David makes. Now, in my last few videos, I've pointed out, especially with Spark and with talking about Sprott, that what we're looking for is we want to see a bidding war break out between investors in physical silver and the Silver Users Association. Now, a lot of people have defended the Silver Users Association. I don't defend them at all. They're a cartel, and their goal is to suppress the price of silver so that they can use it up cheaply. And what's so disappointing about it is that they don't really even need a cartel for that, because the percentage that they use is so small. So it's almost like they're in cahoots with the silver suppressors who are on the monetary side, and they're just trying to take their pound of flesh out of silver. So I wouldn't at all have a problem seeing the silver users have to pony up and pay up a lot more money for silver when they get into a bidding war with the silver investors, the physical silver investors. So I wanted to segue from that over to some numbers that I've covered before, and these are numbers about gold and silver. If you remember, David Morgan talked about, and I'm going to go to 3 different charts here. David Morgan talked about this idea that everybody needs to own a little bit of gold and silver. And I think that was realistic in the past, but it has become completely unrealistic now due to the fact that it's just not there for them to invest in. But I just wanted to have you look at some historical figures. These are going to be different because they're based on different things, but you can see this is one of the key ones from Agora Financial that a lot of people have cited. And you can see it's got the years 1921, 1932, 1948, 1981. And this is from 2009, but you'll see from the other graph that it hasn't changed that much. And you can see that the percentage of precious metal, this is actually gold and gold mining shares as a percentage of global assets. You can see that in 1981 at the top of the last bull market, and 1948 at the end of the war, 32 at the beginning of the Depression, 21 at the beginning of that boom. That we're looking, if we take the average here, we'll say like 25%. We're now at 0.8%. So it's an incredible disparity. Not only, as David Morgan pointed out, is there not enough to go around, but there isn't even any participation at this point. So let's look at another one of these, because these have some different takes on it. Now this one, that's the same one actually. So we want to go to, this one is from Casey Research, and this is gold as a percentage of global financial assets. And this shows 1980. Now this is showing that in 1980 it was almost 3%, and we're at about 0.5%. So that's a 6-fold difference roughly. Now I wanted to point out here that back in 1980, Now, I don't know the specific facts, but I'm just extrapolating. Back in 1980, gold as a percentage of global financial assets must have been physical bullion because we did not have the ETFs. People were buying futures, but those were short-term things. So I'm speculating that this 3% here was physical bullion. Now, if we fast forward to today, where we have all these fake paper instruments, all of these ETFs, where supposedly people are investing in gold, but in reality there's no gold there, except for maybe Sprott, then, or some of the other ones that are above board, but I think GLD and the others are very questionable. So not only is this percentage very skewed, it's not even close, it's a six-fold move, but this bar that we have back from 1980 was all physical gold, and we don't know what this 0.57%, how much of that is considered to be the ETFs. So it might be a much smaller number. It might be something like 0.1 or 0.2%. So that's that chart. I want to take you to a third chart. Actually, no, I wanted to take you to an article that is about these global financial assets. Those were charts on gold and silver as a percentage of global financial assets. And this is just a article that I grabbed to show you what type of money we're talking about here. So this is a projection that global financial assets will reach $317 trillion by 2020, but they happen to mention here the projected worth of financial assets in 2020 would be nearly double the value of around 198 trillion witnessed last year. So we're going to go with that figure, and we're going to say that global financial assets are 200 trillion. So let's go back to our chart here, and this is a percentage of global assets. So if gold is, let's say gold is 1%. So we'll take out our dreaded calculator here, and we want to, well, we don't need to do the math at this point because you can just do it in your head. So 1% of 200 trillion is going to be $2 trillion. Now, we're not sure what is gold and what is silver. So let's just, to be on the conservative side, let's just say it's 1 for 1. Now, if you remember, Eric King has had Eric Sprott on very frequently, and the others, and just about every time Eric Sprott is on recently, he's mentioning the fact that silver and gold are at a 1-for-1 ratio, dollar ratio. So the number of dollars that are pouring in to silver every year, physical silver, are the same as the number of dollars that are pouring in to gold. Yet we have this strange 50-to-1 ratio that doesn't seem to come down. So as Eric Sprott is constantly pointing out, that cannot go on forever. That must end. And it's obviously going to end with much higher silver prices. Is going to be the resolution of that. So, but for argument's sake, let's say that they're at a 1-for-1, and we're just going to do 1%. So we've got $2 trillion, which is 1% of this global financial assets that we presently have, and we're going to say that much goes into gold and that much goes into silver. So let's say we take our 2 trillion and we want to divide it by the 750 million ounces that we get every year. And that comes to $2,666 an ounce. Now, if we said there's 2 billion, let's say there's 5 billion. So we would have to divide this number by 5, let's say. So at that point, we're talking about $500 an ounce. So our most conservative estimate would be, say, $500 an ounce. That's at 1%. What about if we return to historical norms where we're 20 times that. 20 times $500, $10,000 an ounce. So you do the math. The eye of the needle at this point is so small that I don't see how we can return to the percentages that we saw back in 1980. So we're nowhere near what we were doing in 1980 because the participation is so tiny at this point. And yet, when we look at the gold chart, we are appearing to launch into a parabolic move. But the thing about parabolic moves is they can always go higher. So someone at the time looking at this parabolic move right here would have said that's it. That's the end of the bull market. And a lot of them did. And you can see the correction came to right here. So normally when you have the end of a bull market in a parabolic move, you take out about 80% and you come all the way down. So that did not happen there. Now we've got the same situation here. So a lot of people said that was the end of the bull market, and then we had the correction down to here, and that was actually a steeper correction. It didn't lose down here where you're talking about 70, 80, 90%, but it lost more than it lost here. But then we rallied. Now you can see we're in the current correction. It's actually a very mild correction historically, and then we're going to be moving higher. So it could be that we're actually at the beginning of a tremendous parabolic spike, something that will go just to the moon. And we'll look back and we'll look at things like this and things like this, and we won't even be able to see the differences in the chart because the move will be so violent to the upside. Something like a move to gold 10,000 and silver potentially 500 or in the thousands. That's quite possible when you look at the percentages that we have in the precious metals. Basically, no one is participating at this point, and as David Morgan pointed out, they really can't participate because if just a small percentage of Americans grabbed a couple ounces of silver, that's the entire yearly mining supply. So it's a very tight market. You've got to stack silver while it's still available because there's probably going to come a time with these suppressed prices that it's just not available. And we'll talk to you next time.